Let's move on quickly to commodities here. Specifically, I actually want to talk about precious metals, but you mentioned commodities earlier. Anything you might want to say about them, because I suspect that some of these sectors you're talking about that are undervalued relative to the rest of the market may be a lot of the commodity producers. I think most people watching have seen that chart that we've put up many times in the past that show the relative value of the commodity complex to the S&P. And it's beginning to start heading towards the mean, but it's got a long way to go still. So specifically, so say whatever you want to say about commodities in general, but specifically about precious metals. More conventional investors, guys that weren't gold bugs, didn't really invest in gold before, perhaps at all. Thinking of folks like billionaire Sam Zell, but there's been a parade of other billionaires that have followed him recently, are moving into the precious metals. And I guess the question is, do they see something coming that the rest of the world hasn't woken up to? I mean, a lot of folks watching here already kind of know the general case for precious metals, but I've been hearing a lot, both from today's conference speakers, but just a lot of the folks I've been interviewing on the program here over the past couple of months, that they see gold, and really silver even more so, better positioned both technically and fundamentally than they've seen it in years, if not decades. Do you see similarly?
I do. I think this is still a really good environment for gold and silver. I became bullish on them starting in late 2018, and we've had some corrections along the way, but I think that this overall bull market is still intact. And basically, if you look at back in 50 years of data, gold's strongest correlation inversely is with real interest rates. And so if you could hold a 10-year treasury and get paid 7% while inflation's 4%, that's not a bad deal for a relatively safe asset. But if inflation's 3% even, but the treasury yield is only paying you 1%, well, suddenly that's a really terrible asset to own, and suddenly a zero yielding scarce asset like gold is a lot more attractive. And so what I think a lot of these investors are seeing is that we've been in an environment for a long time of negative real rates on the front end of the curve, and that's still likely to persist for a long period of time. The Fed is specifically willing to let inflation overshoot their target while holding rates low. And so if you're holding treasuries or cash, you're getting gradually devalued with the risk of a more sudden devaluation event and very little upside. And so I think basically there has been a good case for the past couple of years at least to substitute part of a bond portion of a portfolio with gold, because you get similar defensive characteristics with an inflation hedge, and it basically diversifies that risk. So you don't have, say, a whole 40% of your portfolio sitting there in treasuries or something like that. And so I do think that gold has historically been a good diversifier, especially in this type of environment with negative real yields. The other big correlation that gold follows is broad money supply growth. And the year 2020 had the biggest percent increase in broad money supply since the 1940s. And so a lot of investors have watched that and are paying attention to that. And so I do think that going forward, gold and silver and other precious metals are well positioned. And then if you look at in the broader commodity space, I think that's one of those things where you can, because it's a very volatile sector, you can get ones that are temporarily overheated and things like that. So for example, copper and lumber have been really consensus trades for a while. That might be cooling off to some extent. But for example, energy is still a very, very hated sector for the most part. And there are other types of commodities out there that are just not very well loved. And so overall, I think that the market might be excited about commodities in kind of the near term, but the market is still not positioned for a multi-year commodity run. And I think that's actually pretty likely to happen. And so, for example, I'm pretty bullish on energy companies. I'm pretty bullish on some of the industrial metals companies, and I do think that they play a really valuable role in today's portfolio.
Yeah, I mean, I think for some reason a lot of investors forget that the economy can't do anything without energy, right? So when energy is underpriced, it's usually a sign that something important's on sale. Also, a lot of the more recent stimulus packages, who knows it's going to pass, but Biden just proposed a $6 trillion one. Those are all to build things, right? And we had Rick Rule in the program not that long ago talking about just sort of the structural supply shortages that are going to emerge. So even on those base metals like you're talking about, there's certainly a big tailwind against that sector. All right, God, there's so much I want to talk to you about this. We're just crunched for time, but I will squeeze in this one last question about precious metals, because you mentioned something really interesting, that you see gold as a good kind of bond substitute in a portfolio given current conditions. When you think about the general sort of 60-40 positioning of most portfolios out there, the average portfolio has almost no gold in it, right? And it wouldn't take many percentage points of what are currently allocated into the traditional portfolio in bonds into gold to just make gold explode. Is that correct?
Yeah, pretty much. And if you look at, the global market cap that's estimated to exist for gold is 10 to 12 trillion. But when you factor out central bank balance sheets and a couple other purposes, you really only have, a few or several $trillion in gold as an investment. And that's out of a sea of assets that are hundreds of trillions. And so it's a really small percentage of most investors' portfolio. And so, for example, if you were to see pensions all want to do a 5% weighting, that's a ton of capital floating into the space, let alone if every millionaire wanted to have a 5 or 10% allocation. And then retail investors, jump on when the price is in their favor. And basically, if most people want that non-zero position or more than a 1% position, basically that's a problem for price in a good way. And so overall, I do think that basically there's more upside for gold with say a 3 to 5 year view than the downside. And so that's why I'm willing to kind of hold through downside periods, because I still think structurally gold is really attractively priced here. And mostly what, in terms of timing, I basically, it follows the broad money supply generally over the long term, but those changes in real interest rates really set the tone for basically, whether or not gold is going up and down in any given quarter. And so really what gold likes to see is negative real interest rates that are also getting even more negative. That's kind of the best possible environment for gold. And so if people are ever confused about why gold might be correcting or might be popping, a lot of it is if you look at real interest rates, that can often tell you basically what's happening. And gold can either front run those a little bit by a couple weeks or can lag those by a couple weeks. But overall, there's a very, very strong correlation there.